And we're back on the podcast. I'm joined again by Ernest. What's going on with you today?
Apparently, I just got an email from the school board saying that they're going to shift the PA day because of a solar eclipse.
Yeah, I saw that on the news. Explain do they not want kids looking at the sun or the eclipse or something? Worried they're going to burn their eyes?
No, I didn't. I thought it was just because they wanted people to see it. But I don't know why.
I don't know. We'll have to do some more investigation and get back to you on the next podcast as to why that's happening. My son is in University of Montreal, and apparently they're on strike in Montreal. The university professors or the teaching assistants. So he's off school this week. So a lot of fun to be paying for school with PA days and strikes. But I guess that's the way it goes. No strikes for us, though.
No, there is definitely, the markets don't strike.
Oh, so I thought before we get into our feature discussion, people want to know what you do during earnings seasons. We're in the thick of it now. Earnings are coming in fast and furious. And I thought it'd be interesting for you, Ernest, to talk a bit about what your day is like and what you try and focus on, the key points when our companies report their earnings.
So companies are legally required to report their earnings on a quarterly basis. So this usually, for most companies, this usually covers the 3-month period beginning with from January to March, April to July, and so on.
So companies are now reporting their fourth quarter earnings for the period ending December 31st, 2023, give or take.
Yeah, you don't have to follow that calendar, but most companies do just because it's easier.
And it matches probably their corporate year end, right?
Exactly.
Most people who have companies, their corporate year end is December 31st, just makes things easier. So,
So most of the things that are reported are just noise. Like it's just what happened in the quarter, maybe what's your outlook for the rest of the year. I think the fourth quarter results, which are currently being reported, are a little bit more interesting because the companies are going to provide guidance for the upcoming year. So they'll talk a little bit about what they think is going on and how they see the year shaping up to be.
And so when a company reports earnings, generally they'll prepare their statements for the quarter. And as well, they'll have a conference call generally, right? So what type of things are you looking for in those reports, in those conference calls?
So in these calls, they are the people asking the questions are usually sell-side analysts. So these are people who work for banks or brokers who publish investment research as a living.
That's right. So they're the ones who say, I give Apple a buy and my raise or lower my target price to X or whatever.
A lot of the questions are nitpicky, what we call modeling questions. So like, what do you think the tax rate is going to be for the rest of the year?
And why are they asking those kind of nitpicky modeling questions?
Because ultimately what a lot of these analysts are trying to do is they are trying to create a price target based on a financial model, which is something that everyone should do. But I would say sell-side analysts are probably more focused on creating a model than looking 5 or 10 years out.
That's right. They're trying to justify why the stock is trading where it's trading and come up with a valuation for a very short period of time.
I think what I like to look for in these earnings calls is that this is typically the only communication that the management has with its shareholders. Like from time to time, you can call the investor relations team and talk with them too. But for companies such as Google and Microsoft, this is the only time, apart from company events, where you will hear them talk about the business.
You can call up, Ernest, a company that has a smaller market capitalization and really have maybe a meaningful conversation, even with the CFO there or the CEO. But you can't call up Google or Microsoft and speak to the top people. They will not take your call.
Exactly. So a lot of what I like to do is I like to pay attention to what these people are saying, how they're thinking about the business going forward. Maybe if somebody asks a tough question about like a competitive threat to the business, how they answer it and how they think about things.
Yeah. We don't necessarily care how many widgets they're going to sell in the next 3 months as long-term investors. I mean, it's sure, it would be great to not have a company miss expectations in a short period of time, or, have a stock go down or be embarrassed. But if the thesis is unchanged, we're just going to ignore the short-term noise, right?
Exactly. And that's usually what ends up happening is like the company will report earnings, the stock might go up or down a couple of percent. I'll review it, not really any change to the long-term thesis, and then we move on.
So many times you'll see a stock report earnings and beat the estimates that the analysts have modeled for, and sometimes the stock will go down.
Yes.
Sometimes it will report earnings that are terrible, way worse than expectations, and the stock could go up, right? So it's all about essentially what is priced into the stock and what the guidance or the outlook that the company may give on the call.
And I would say that the near-term financial things, the questions that the sell-side analysts typically like to ask about, those things are usually pretty well priced into the stock. So if the company in Q3, for example, they said, we think Q4 is going to be bad. And then Q4 was bad, but was not as bad as everyone hoping. And maybe the CFO said, had a tone that the economy was improving and that things were going to be better going forward.
Sometimes
the stock might go up.
Yeah, sometimes they may say, well, Q4 was bad, but in December, the last few weeks, things improved. And we're feeling better about the year upcoming, even though they have maybe had a lousy report, and everybody knew they had a lousy report, stock can rocket higher. And we've seen that so many times.
Exactly.
And there's also what we call the sober second thought, where possibly the company reports earnings and the market either loves it or hates it after hours. And then the next day there's a different thought process and that turns around, right? We've seen those reversals too. So you can't learn a lot from stock price movements in the short term, especially after earnings reports.
No, you really can't. And one example is Google this week. I think the stock was down 6% on earnings because the CFO said they thought that she didn't say it directly, but she implied that the revenue growth rate was going to be a bit lower in 2024, right? I think investors can sometimes read a little bit too much into these things and kind of lose sight of the big picture.
And it possibly could be the truth. And then, of course, now that they've set the table that the revenue could be a little bit lower, even if it comes in a little bit low, but not as bad as what people thought it could be, Google stock could then just shoot right back up or even dramatically higher because, we feel so much better that it wasn't that bad.
I would say in our experience, like there is a whole industry of people and data and companies that try to pinpoint exactly what earnings are going to be and how far off the consensus it's going to be and those kinds of things. Like you can pay for services that track parking lots of retailers, right? And estimate whether traffic is going to be better or worse than what the management said.
Like, for example, you can see people subscribe to how much they think Amazon is going to report in retail sales. Where do they get this data? Is it all nonsense anyways?
Yeah, I think it's mostly inferences around like there's credit card data you can buy, like there's satellite imagery you can buy. There's no end to it, really.
By the way, clients, we're not spending your money on that kind of stuff.
And the reason that we don't do those things is I think it's mostly noise in the long term. I think it makes you lose sight of the big picture, which is what the company is doing to gain market share and to grow over time.
That's right. And Google also said that capital expenditures in 2024 are going to be higher than 2023, possibly, and things could change. But that may actually be a good thing. Maybe they're strengthening the moat, building out another competitive advantage. We don't know what they're working on. And I think Google is famous for being pretty cagey on their conference calls and not same with Apple. They'll always say, yes, we're working on AI, but we're not going to say one word about it. So, and sometimes these calls are useful. Some companies that we own, like Constellation Software and Berkshire Hathaway, don't even have conference calls. They will tell you nothing. And you'll hear a lot about Berkshire at the annual meeting, but it's really folksy advice on how to live,
Yes,
right?
yes, exactly.
I mean, I assume Warren Buffett has already said all he needs to say about how he's going to invest going forward. And but getting back on point, we're going to talk about a few companies that have reported their earnings this quarter, and then we're going to have a feature discussion of a company that we have owned for a while but haven't talked about. So, speaking of Google and Microsoft, Ernest, both companies. I hate using this, but both companies beat earnings expectations. Microsoft gave a very strong outlook. Google not as strong. Both stocks went down the day after reporting earnings, but that had more to do with the Federal Reserve possibly not lowering interest rates faster than people expect. But that's neither here nor there. So, any points you want to talk about Google and Microsoft?
So I think it is really incredible how fast these companies can grow at the size that they are, right? I think a lot of investors typically, they look at something like Microsoft and say, well, it's the largest company in the world, right? How can it grow double digits forever?
Yeah, right. Then Microsoft grew revenues by 20%.
Yes.
That's mind-boggling.
Yes.
Yeah.
And the reality is that these are just outstanding businesses that continue to do that.
Google has more revenue. Google has more revenue than Microsoft, I think.
Yes.
And grew revenues by 13%. And I read that search revenues accelerated. Haven't people already searched all they need to search?
Yes.
Yeah. So it's very interesting how these companies, as you said, growing at scale.
And for Microsoft, I think the main focus on the earnings call was around what they're doing with AI, especially since AI is an increasingly large contributor to their cloud business. But I think there were a lot of other things that were pretty positive as well. Office, just plain Microsoft Word and Excel, that continues to grow double digits.
So what's happening there? Are people converting from they used to pay for the software once and use it for a few years, and now everybody pays on a monthly basis?
Yes.
They're raising the fees. They're getting more subscribers.
Yes. So It would be, there might have been take Baskin, for example.
Yeah.
10 years ago, everybody was using a licensed version of Microsoft Word and Excel and PowerPoint. Over time, all of these users are migrating to the cloud version, 365, because partly for security reasons, but also because they're adding a lot of new features into the new thing.
Yeah. And 10 years ago, Baskin had 12 employees, and now we have 26, 27. So there's 15 more employees that we have to pay licenses for. And that, I assume that price goes up every year.
Yes.
Yeah.
I think more notably is that they talked a little bit about Copilot, which is their AI assistant that is being integrated into a lot of their products. So, for example, I think the most famous use case today is something called GitHub Copilot, which is a tool that if you're a programmer, you're writing code, GitHub Copilot will write code for you. So you could save a lot of time.
I don't know how to write code, never will, but it sounds like an interesting product. Is there any Copilot projects that will be applicable to the regular Microsoft Word, Outlook user?
Yes. So they are also, they've also launched 365 Copilot, which is implemented into PowerPoint, Excel, and Word, and Teams.
So can it answer my emails for me?
Yes, it actually can. And that's one of the use cases that they're seeing, is that you can now use an AI assistant to write drafts of meetings that you've had, summarize your databases, those kinds of mundane things that previously would have taken you a long time to do.
And we're just getting started with AI being an assistant to helping with productivity, right? This is just scratching the surface.
And the reason that this stuff is is important for Microsoft stock, beyond being pretty cool, is that the more Microsoft and software in general can save you time, right? That's pricing opportunity that they have, because if you can save a developer like half their time, that's less developers that you need, because you can write more code, and that's going to be true for, I think, across their portfolio.
I think so. And of course, everybody's already integrated into Microsoft products. It runs our home life. It runs our business life. It runs the world. And it's a name that you trust. And so I think the sky's the limit really for Microsoft and what they're trying to achieve.
And we didn't even talk about Activision. I think Microsoft is such a big company today that they can make a $60 billion acquisition and you don't hear anything.
Nobody
about
cares about it. The Activision's going to add what, $7 or $8 billion of revenue?
Yes.
Yeah, to a company that's going to do well over $200 billion of revenue. It's a rounding error.
Yeah. So we'll see what happens with that.
But it doesn't hurt. Google, we talked about the stock dropped as a result of less than exciting guidance, but anything that caught your eye as a long-term investor that gets us excited?
Yeah, I think there was quite a bit. There were fears. Remember in the beginning of 2023, there were fears that AI was going to disrupt Google.
Totally.
That everybody was going to do all their searches on ChatGPT.
Or switch to Microsoft Bing.
Yes.
Which did not happen.
So I think what ended up happening, and you can see this from the results, is that this just didn't happen. Engagement is up across the board even for search. So people are searching more. Their core businesses like YouTube, Maps, Google Assistant, and all these kinds of things are still growing very nicely. And they're adding new ad formats to take advantage of that.
Amazing.
Right? I think that we talked a little bit about the tone of the weak guidance for 2024, but I think at the end of the day, right, this is a fantastic business trading at 22 times earnings.
Yeah.
They're going to make a ton of cash flow, and all of it's going into buybacks. So I don't.
And even if the organic growth slows down from 13% last quarter to 9 or 10 or 11%, still pretty good. And of course, you don't know what's going to happen in the prior year, in the future coming years, and the investments that they're making in AI, how that will accelerate revenues, right? These are companies are driven to make more money, right? And good things happen when you have balance sheets like Microsoft and Google have. Incredible. Google has $100 billion net in cash.
Yes.
So that's insane.
And then they're also looking at ways to using AI to improve the cost structure of the business, right? So I think Google seems attractively valued.
All right. One quick one. Ferrari, we did a podcast on that. We've talked about the name a lot. The stock is up an incredible 12% today, which is shocking to me, but the company, I guess, once again, the guidance was better than feared. This was not a company that came out with saying that, we're going to sell double the amount of cars and everything is the best it's ever been. But I think there was some fear that the company would lower guidance or say, because they kind of said that 2024 is not going to be as fabulous as it was the past few years, but clearly the guidance was good enough.
So basically Ferrari said their order book has stretched out all the way past 2025 now.
Yeah.
You can't buy a Ferrari before that.
Yeah. Well, we're into 2020. Yeah. And so orders are now being taken for 2026 and nearly sold out.
I think one thing that is interesting about Ferrari is that if you look at 2023, they only grew car units, cars sold, by about 3%. But revenues were up much more than that.
Yeah. Well, they're not making more cars, right? Their goal isn't to double car production every few years. It's to incrementally add new cars and new lines and at higher price points and so on and so forth, right?
Yeah. And so they've raised prices substantially, partly because of inflation, to cover the cost of inflation, but also because personalization. So like picking the rims of your car, designing the interior. Yeah. These have become a pretty material portion of their business, 20%. And it's continuing to grow.
Yeah, and this is not if you had a Toyota and you're adding some extra features that may cost 10% more the price. People are for personalizations of Ferraris, you're talking about spending hundreds of thousands of dollars more on the price of the car.
Yes.
Right. So it's and very margin additive, I would expect as a result.
Yes. The average Ferrari buyer tacks on 20% more on top of their purchase price in terms of personalizations.
Nice. Good for us. So a lot of people are talking about, have said, Barry, I'm so excited that Lewis Hamilton is joining the Ferrari Formula One team. First of all, I don't follow Formula One. I don't know who Lewis Hamilton is. And is this
like
something,
me not knowing who The Rock was?
Yeah, you like our last podcast. I mean, I follow wrestling. I don't follow F1, but I assume it's the same stuff. It's these are exciting people that could bring in more sponsorship and sell more swag and build up the Ferrari brand.
Yeah, I think the swag and and that kind of stuff is secondary.
Yeah,
I think the big motivation is that Ferrari doesn't spend on marketing. Like you won't see a Ferrari ad on TV, right? The only marketing that they do is through the F1 activity, their racing team. And so to the extent that they can get a superstar driver who can hopefully give them some better results, like I think that's only a positive.
They don't make a lot of money on the F1. No, it's really just to show what the cool, sexy car that they come out with, and to build up the brand and show it's an awesome car, and you got to have it because they win all these Formula One races, right?
And more importantly, is that a lot of the technology that they use in their F1 team is actually integrated into their cars. So like they can go out and tell their clients, "Oh, you're buying a car with like racing car technology," and it's actually true. So that's there have been Ferrari is, I think, not unique in our portfolio, but Ferrari has always traded at a lofty multiple, and I think that the reason for that is because is what you saw in this year. Like they can grow volumes at 3%, but profits are up 30%, right? So even a very small increase in car production has a very, very strong flow through to the bottom line. And as they move into things like SUVs and electric cars.
And now maybe boats.
Yeah. Like I think there's a lot of opportunity to grow.
Awesome. All right. So our feature discussion is a company that I'm sure a lot of our clients have even have their products in their body, but they don't really know the brand. But it's a company called Stryker. There's an actual Mr. Stryker, right, that
Yes.
founded the company. And Stryker is a leading orthopedic manufacturer of hips, knees, joint replacements, as well as a number of other medical devices and selling stuff to hospitals. So, Ernest, when did we buy the stock for our clients?
2020 or 2021.
Yeah, I think
something like
2021. Yeah, but we always are interested and fascinated by the healthcare space. We shied away, Ernest, from owning pharmaceutical companies. Right now, to our detriment, because we don't own anything involved in the the weight loss Ozempic type businesses. But we always like the medical device technology, and so let's talk a little bit about Stryker and why we like the industry and where we see it going.
Right. I think, as you pointed out, we don't really invest too much in the healthcare and medical sectors, mainly because, look, my degree is in accounting. I don't know anything about drugs or about healthcare.
I've got a business degree. I don't know anything about pharmaceuticals either. And just very tough, right?
It's a very tough lots of things that you have to grasp. You have to understand, will the drugs work? You have to understand, the regulatory environment. It's very, very tough. So we largely don't play or own companies in that space.
That's right. And we certainly wouldn't invest in biotech or things where there's a binary outcome. It's beyond our capabilities, as you mentioned.
So Stryker is a little bit different. And the reason is that most of their products are not what most people would call leading edge healthcare products. Mm-hmm. They're not going out and creating a new life-saving device that nobody ever thought of.
Okay.
Most of their products that they launch are incremental improvements over the previous version. And the reason why this matters is because, at least in the United States, the approval process is very different. If you have if you're launching a new hospital bed, right? Like, you don't have to go through a full approval process with clinical trials and all those things. It's just a new bed.
It's a bed.
It's a bed.
It's a bed. It may go up a little bit more than the previous one.
Exactly.
Yeah.
So there is a different approval process for these products that is a lot faster.
Yeah.
Is a lot less rigorous, and quite frankly, doesn't require any like substantial R&D efforts into it.
I mean, on the other hand, you don't have the patent protection like you may have for a pharmaceutical product.
Right.
I mean, you may have some patents for the product. Anyway, we're getting off topic, but okay. Yeah.
So for Stryker, about 60% of their sales are from hospital equipment. Mm-hmm. So think of things like surgical tools, hospital beds, cots, like badges that nurses can wear, and all these kinds of like things that a hospital needs to exist on.
And as our population grows, as our population ages, do you think we're going to need fewer hospitals and fewer equipment going forward?
No. So that's 60% of their business. Mm-hmm. The remaining 40% of their business, but a larger percentage of their profits, is from their orthopedic implant business. So these are hip and knee and shoulder and ankle joint replacements. And orthopedic implants are a really good business for a variety of reasons. Number one is that the surgeons that perform these surgeries, they typically have a brand that they prefer to operate on.
Absolutely. They may have been mentored on that brand, got their degree based on that brand, learned from another doctor on that brand, had intimate, that's the wrong word, but the good relationships with the company on that brand. And so therefore they're going to be a Stryker doctor.
And the surgeon, like, not surprisingly, he doesn't really care if the competitor is selling their implant for a lower price because he's used to operating with Stryker, for example. Mm-hmm. And hospitals, the people that employ the surgeons, correspondingly, like, they're willing to accommodate the preferences of the surgeons because orthopedic surgery is one of the most profitable procedures that are offered by a hospital.
And it's also a star-based type service, right? You want to go to the orthopedic surgeon that has the best rating, that has the best bedside manner, that gets the surgery done in such a way from referrals. And so they may be willing to pay up for that surgeon, and essentially that surgeon calls the shots.
Well, maybe just to clarify quickly, this is the United States, which is a for-profit healthcare system.
Absolutely.
Yes.
Yeah. But I think it's still true for Canadian hospitals as well.
Yes.
Pride of having the best surgeon in their field. Yeah.
So as a result, there are essentially 3 orthopedic implant companies, and they don't really change market share too much because of all the dynamics that we just talked about.
Right. So Dr. Ernest, if you're a Stryker guy, it's going to take you a lot to switch to Smith & Nephew or Zimmer or Johnson & Johnson, right? Yeah.
Right. Those are the 3 players.
Those are the 3. Johnson acquired Smith & Nephew?
No, they've been in it for a while.
Okay, yeah.
What happened is there's 2 things. Number one is that Stryker acquired a company called Mako, which makes a robot that helps with orthopedic procedures. At the time that they did the deal, it was controversial because nobody was using robots to do these implants. But now, like, everybody is doing them. And the reason that this matters is because once a hospital or a surgeon has a Mako robot, you have to use a Stryker implant. So
razor blade model?
Yes. Yeah. So that's been a big driver of their business. Number 2 is that the largest company in the world, which is Zimmer Biomet.
Zimmer is bigger than Stryker?
They were.
Okay.
I think they're about equal today. Zimmer merged with Biomet.
Yeah. We used to be shareholders of Zimmer.
And in the process of the integration, they had some supply issues. So they just weren't able to get their implants out to doctors.
That's why we sold the stock, by the way.
And and as a result, surgeons that even preferred Zimmer Biomet implants had to switch, and a lot of them switched to Stryker.
And they're not going to switch back
No.
to Zimmer. Yeah.
And so those have been two main tailwinds, and Stryker has outgrown its competitors like pretty substantially.
So Stryker has taken market share from its competitors.
Yes.
What about pricing in this industry?
There's very little pricing opportunity because these are already fairly high margin products. There has been some concern over the years that people are paying too much for these implants, especially since Medicare pays is a large client, right?
Yeah.
They do a large chunk of the reimbursements for these surgeries.
Yeah, in Canada, of course, the surgery is covered under your healthcare plans or your provincial healthcare plans. In the U.S., a knee replacement can run up to $60,000 per knee.
Yes.
Yeah.
And
or higher. That was a few years ago, I heard.
One last thing that Stryker has done is they went out and bought a company called Wright. So Wright is the leading provider of what they call extremities implants. So implants for your shoulder and your ankle. This is a fast-growing area of orthopedics because the implants historically have not been as good. And as the technology improves, as the surgeons become more comfortable operating, you can increase the amount of indications that it can be used for, right? Previously, you would only replace your shoulder if you really had to. But now, like, as the technology has gotten better, the surgeon is going to be more comfortable prescribing it to you. So that's something that has been growing very rapidly for Stryker.
So there's lots of tailwinds in this industry, of course. The aging population, the potential of larger percentage of obesity in North America, leading to more stress on the joints, as well as a potential in emerging markets, right, where typically these surgeries aren't performed.
Yes.
So, I mean, everything is turning up roses for Stryker.
Yeah, I think one last thing that I would add on is on their M&A strategy. And this is, I guess, not too unique to Stryker, but most large medical devices companies typically are fairly integrated into, like, they have relationships at the high end of the hospitals and the health networks.
Okay.
So they can go out and acquire these little healthcare companies that maybe made a new widget, and then they can flow that through their sales network and immediately generate synergies from acquisitions. And so that's been a fairly important contributor to their business over time.
I assume that the Stryker salespeople are very close to the surgeons that they work with,
Yes.
and having regular phone calls and meetings and updates and presentations. And have you thought about this? Can we add this? What can we do for you? I assume that also Stryker is great at listening to surgeon complaints and making fast changes to their products and their services as a result.
Yes, and I think one area that you've really seen this bear fruit is in the ambulatory surgical centers,
Okay.
Which is called ASCs, which are outpatient facilities that you can go do a surgery and then go home and not have to stay a whole night.
So what's happening is they don't want the hospitals cluttered with people going for orthopedic surgery. And this is something that's probably going to happen in Canada as well. Having specific surgery centers for orthopedic surgery, which makes a lot of sense. You don't want to integrate people that may be staying overnight or half a day for surgery with those that are very sick, and it just makes sense. And so more of those centers are popping up in the US to perform those types of surgeries.
Yes.
Okay.
And Stryker has been growing very rapidly in this channel because of their ability to provide a whole bundle of equipment to these centers. Mm-hmm. So that's something that they've benefited from as well. Mm-hmm.
And that's an excellent. So talk about, Ernest, valuation and Stryker and how we see it going forward.
When we purchased the stock, it was trading, I think, kind of similar to other medical device companies, but they've executed pretty well. They've grown pretty rapidly. So now it trades at a bit of a higher multiple than its competitors. Actually, quite a substantial, quite a substantially higher multiple than Zimmer, for example.
But for good reason.
Yes.
When we bought the stock, we bought it during COVID, after the main crisis, but in 2021 when there was a gigantic backlog of these surgeries. These surgeries were put off, of course, because hospitals were overflowing with COVID-related issues, and certainly no one needs to get knee replacement surgery the next day, right? I feel for those that are in pain when their knees and their hips and what have you, but it's something that you can wait to have the surgery for.
Yes.
But clearly so. One of the knocks on could be, well, Ernest, isn't it just a recovery from all the backlog of surgeries, and will the growth slow down from here?
Maybe a little bit for the orthopedic business, but like you said in the beginning, there is still a large demographic tailwind for the business.
And let's talk quickly about these weight loss drugs. As a result, of course, wonderful. I mean, if these drugs do work in the next iterations, people will lose weight. And that could put less stress on their hips or their knees, which could, the theory could be you won't need hip or knee replacement surgeries if you're in great shape. But not all hip and knee replacements are due to obesity or wear and tear as a result of being obese, correct?
Right. And so like pickleball, for example, has been cited as one contributor to their strong growth because it's a way for older people to be more active. And as they become more active, like unfortunately things happen. So then they have to go and get joint knee or hip replacements.
Yeah. So Ernest, have you seen some of these people in pickleball? They're amazing. I mean, yeah, you would think it's a sport easy to pick up, but some of these people smash the ball really hard. So what I was going to say is with the weight loss drugs, it could encourage more surgeries as well, because a lot of surgeons are afraid or say to their patients, listen, you need to lose 20, 30, 40 pounds before I can do the surgery, because there's other complications that could happen from surgery. This is no joke. They're putting people under anesthetic. They're putting people out to do the surgeries, and there are risks, right? So they ask people to lose weight. But now with the weight loss drugs, there's a potential that you could lose weight and then be a candidate for the surgery where maybe you wouldn't be able to lose weight on your own.
Right. I think that I think it's kind of hard to project exactly how it'll play out for their orthopedic business. It'll probably have a bit of an impact on some of their other business lines, such as their endoscopy, like stroke management business and those kinds of things. But like, I think for the time being, like we haven't really seen any impact so far.
We haven't, and we don't know the long-term impacts, and these things do ebb and flow.
Like for example, like will these drugs end up causing other health complications?
Exactly, and of course we know that people that go on medication, one of the problems is that they don't stick with it, just like anything else. So, any final words on Stryker?
No, I think the way to think about Stryker is a very well run business, just like the rest of our portfolio, and we're happy to own it.
Very good. Thank you so much for joining us today. We'll see you back here real soon.